All right, so welcome to your tour of Chapter 8, which focuses on receivables. Okay, we're going to be finding out how companies report their receivables, which of course is receivables are asset account. And so it's going to be on the balance sheet. So they have to go through a few things in order to report them. And then the chapter ends with some more financial analysis. We're going to be introducing you to a couple of very simple ways of analyzing if we're collecting money in a reasonable amount of time. All right, so we are going to do a real quick tour of all four objectives. Most of the work is going to be in objective 2 in terms of what you need to understand. Objective 1 is pretty straightforward, relatively easy. Objective 3 is not so bad either. Objective 4 is really the analysis. So most of your time is going to be spent trying to understand what the heck did he just say about objective 2. So just for you to know. Corporations have a lot of receivables on their books. The biggest one and the most important focus of this chapter is accounts receivable. Remember how accounts receivable is created? You sold goods or services to a customer, and you agreed that you will receive the payment later. Right. So you basically give them a bill to remind them that you're waiting to receive their money. So accounts receivable is based on a sale of goods or services on account. So you're going to collect it later. You're going to give them the goods, you're going to do the work, and you're going to give them a bill. So okay, I'll receive it later. This is common among business-to-business transactions. You and I are not going to be able to walk into a store, take a bunch of stuff, and say, "Hey, how about an invoice? I'll pay you later." It ain't going to work. It ain't going to work. They're going to want us to pay now. Okay, so just know this is more business to business. 30 days is usually when we want to have those receivables. You know that from chapter 5 because you saw an invoice and you saw the terms of that invoice were 210 net 30, right? So net 30, the whole thing is due in 30 days. So in essence, accounts receivable are usually paid within 30 days of the sale. Sometimes businesses can't pay within those 30 days. Sometimes they might need a longer period of time, 2, 3, 4 months. Well, what happens then? Well, they can basically talk to the company and say, I need more time. And the company will say, look, why don't we make it a loan? All right. So you'll have 3 months to pay, but I'm going to have to charge you interest on that. And they say, okay, and there's your notes receivable. That's how notes receivable are basically born. They come from accounts receivable, which need a lot longer than the 30 days to get paid. Okay. And so they're simply turned into loans. Remember, the word note is synonymous with loan in accounting. Businesses have a whole bunch of other receivables. Your book kind of explains a few of them, but we're not going to be dealing with those in this particular chapter. But simply, a receivable is you're waiting to get paid, right? You're waiting for cash. Some companies have lots of receivables as a percentage of their assets. Some companies don't. The reason why Ford has a very high percentage of its total assets as receivables is simply how that industry is structured, right? Ford Motor Company makes cars and trucks and SUVs, and they sell those to regional distributors. Those distributors are not paying cash for all of those cars, trucks, and SUVs. Okay, so they might be paying down something, so there might be some cash involved for sure, but most of it is sold on account. So then Ford Motor Company is waiting for the distributors to sell those vehicles to the dealers. And then they will collect that cash once that process is done. So that takes a while, and that means their receivables is a very large part of their total assets, because just simply how the structure of that business is. Service organizations, basically when they perform a service on account, they've done the work and they've left a bill. That invoice is to be received later. Right? That's the accounts receivable from a service perspective, merchandisers sell goods, right? Sell products. So a sale of merchandise on account is usually a business to business transaction like we did in chapter 5, right? One business sells goods to another business on account, meaning that they take the goods, but they're going to receive payment later. Remember that this is the accounts receivable for the seller. The seller is having, this is their accounts receivable. Remember, the seller has those terms. Remember, the 210 net 30 means that, hey, you pay me in 10 days, take 2% off. So even though I might have sold you $1,000 worth of goods, and that's my accounts receivable, is it really worth $1,000 if I've given these guys a chance to take 2% discount? No, right? The cash value could be as low as $980. So that's one of the issues with accounts receivable in terms of as an asset. How do you value something that can sometimes be, a discount could apply, A. B, some businesses might go out of business of being able to pay. So how do you value something like that? Right? And then, of course, accounts receivable change when you sell merchandise on account and the buyer returns that stuff. So what you thought is a receivable, you're not going to get because they returned the merchandise, right? So again, sales returns and allowances reduces those receivables. You saw that again from chapter 5. So this is all too familiar. You know how this works. One company, Jordache, sells merchandise on account to another company, Polo, 210 net 30. You understand how this is, right? Sale on account, debit to accounts receivable, credit to service revenue. You gave them 210 net 30. You gave them a chance to pay less than this. So even though accounts receivable is your asset, and your asset says you're owed $1,000, is that the real value of that receivable? That's the question for the balance sheet. That's what we're going to be tackling in objective 2. Okay. So a few days later, they return stuff. Polo returned something, so now you have less receivables. So instead of now having $1,000 of receivables, it's now $900 because they returned $1,000 of that $1,000, $100 of the $1,000 sale. Sorry, no doubt. And then they paid for it within that 10-day period. So in other words, they're not going to pay the full $900. They're going to pay 2% less. So then that $900 accounts receivable is literally only worth $882 in cash. That's the real value of it because you allowed for an $18 discount. Right. You're still going to say the entire $900 receivable has been received, but it's not, the value of it isn't $900. The value of it in this case is only $882. So this is one of the interesting things with receivables. This doesn't happen as often, but a lot of retailers used to have their own credit cards. Now they basically outsource that and partner up with banks. But some retailers, you would have like a JCPenney card with JCPenney, a Macy's card with Macy's. Now you can still get a Macy's card, but they use a bank to do all that stuff. They don't do it on their own. And that complicated receivables even more when you have your own credit cards and your own receivables from those credit cards. Oh my God, what do you do? Because now you're dealing with customers. You're not just dealing with business to business transactions. Here, you're actually dealing with customers. Holy moly. So I'm not going to go through that, but it does the issue is it does complicate things. So we've seen this way back in chapter 5. It's just a reiteration of that, how accounts receivable are recognized. Anything that you sell on account will create an accounts receivable for you. In this case, Wilton sold Bates $50,000 worth of stuff. Look at the terms. The terms are kind of funky. 3% in 15 days or the net amount in 45 days. That's interesting. Okay. Some industries, and I don't know what industry this is, some industries do work on a longer than 30-day period for receivables. Some do work on a 45-day cycle. So it depends. Every industry is a little bit different, but overwhelmingly it's 30 bucks, 30 days, rather, 30 days. So that happened on the 1st of May. So they're going to record the sale. It's $50,000 sale to Bates, but it's a receivable. The 4th, they returned some stuff. So we're going to have a sales returns and allowance. So now instead of the accounts receivable being 50 grand, you take 2,000 away. Now you got your $48,000 in receivables, just like that. And then within that 15-day period, because it's 3/15, they're taking a 3% discount and sending the rest. And so what happens then is that $48,000 of receivables, which you have on the books, has a value of only $46,560 because that's the cash you collected. The difference is the discount you've allowed them to pay early. Okay. So now you're going to see how this matters, right? If you say your accounts receivable is $48,000 and that's on the balance sheet, that's the real value of that asset on the balance sheet. And the balance sheet is subject to lots of rules through GAAP. One of them is you can't overstate your assets, right? So if you say you have 48,000 of receivables, you're lying. You're overstating them. It's not worth 48,000. I mean, it might be, but as you see here, it was actually only worth 46. So that's something that accountants had to struggle with. And what they came up with is rules within generally accepted accounting principles on how companies need to value their accounts receivable. So this is the part that I said you're going to spend a little bit of time on because it's got the most stuff to think about. So remember, accounts receivable is an asset account. It's a current asset. It's on the balance sheet. We have to make sure, just like inventory in the last chapter, we have to make sure that it's really priced. The value is correct. It's not overvalued. It's not overvalued. Okay. So how do we do that? Well, we have to come up with some situation, and you're going to see how they did, to allow for some of these accounts receivable to be, in essence, uncollected. Okay, there's going to be some portion of businesses who owe you money that can't pay. Look what happened here with COVID. Imagine you're a business, you do business with other businesses. Maybe you're a restaurant supply, company, and they come to you for all types of supplies, right, for their restaurant. And you sell to them on account. And then COVID hits. Well, you were expecting them to pay you in 30 days. Some of them aren't going to be around in 30 days. How are they going to pay you, right? They can't make enough money to pay their rent or anybody else for that matter. So that receivables probably going to go uncollectible, right? It's going to be uncollected. So how do businesses deal with the fact that some of these receivables will be uncollected? Well, it's considered a cost of doing business. It's a loss to the seller. And thus there's an account, this is a new account for you, a bad debt expense account. Okay. So bad debt expense is really about this. Okay. We let some of our customers buy merchandise on account and they can't pay us on time. And even though we kept asking, they still can't pay. So what do? We still have this money in our accounts receivable, right? Should it be there? No, of course not. Shouldn't be there. How do you take care of it? Well, we're going to learn how to do a bad debt. So there are two methods that are used to do the bad debt, okay? Only one of them is required by GAAP, but so that's the allowance method, which you'll learn in just a moment. There's another way to do it for small businesses, and this is not write-off. This is not write-up. It's write-off. Okay, it's the direct write-off method. The direct write-off method cannot be used by corporations in their presentation of any financial statements, but small businesses can use it. They've identified you as a client who they sold merchandise to on account, or they did a service for on account, and they know you're not going to pay. Boom, bad debt expense right away, take you off of their receivable. Corporations, public corporations cannot do that. They have to do something called, they have to use the allowance method to help them estimate what their bad debt is going to be. Okay. And you're going to, and this is the focus of this part of the chapter here. Okay. So although the direct write-off method exists, it's not compatible with GAAP. And so you're not, you can use it, just for different types of businesses can use this, and they do, but it's not desirable, as it says here. So how are accounts receivable presented on the balance sheet? Well, you might not know, but here you're going to get another account. Accounts receivable is certainly an asset account. It'll have balances on the debit side, as you see. What you don't know, what's is new, is there is an account that follows accounts receivable around, just like the accumulated depreciation account for equipment follows the equipment account around everywhere. It's always sort of right there. It's called the allowance for doubtful accounts. Okay, and don't be so doubtful about this, because this is an actual name of an account. Okay, the allowance for doubtful accounts is an actual name of an account. Okay, what does it do? It helps to adjust the value of accounts receivable on the balance sheet. And the allowance really is, this is the expected bad debt. That's the allowance. Okay. So this is what the ledger would look like. You would have an accounts receivable page, and then right after the accounts receivable page, you'd have the allowance for doubtful accounts page right in the ledger. How it looks on the balance sheet is exactly what you see here. Okay, this is one way to do it. It's not commonly done this way. You'll see the common method on the next slide. But accounts receivable, again, it's an asset account, so it's going to be listed. In this case, it's listed at its full amount. And then as you see, we have made an allowance for doubtful accounts. So they believe 25 of this 500 is going to end up being a bad debt for them. They've allowed for that. And that means that the real value of the receivables on the balance sheet has been adjusted to 475. Now, this particular amount is called the net realizable value of accounts receivable. Okay, so when they're looking at what their realizable value is, they're going to use this 475. So again, it's accounts receivable, and then right underneath it, the other account, they would take away allowance for doubtful accounts. Now, because they're subtracting it out of accounts receivable, in essence, the allowance for doubtful accounts works like the accumulated depreciation account for equipment. It takes away from the value. This is typically how it is shown on balance sheets. What you see here is typically what you will see on most balance sheets in the corporate world. You'll have accounts receivable, and what you see is net of the allowance. So they'll list whatever the allowance is. So the word net here means that this amount, 275, is the net realizable value, because it's taken into effect another $25 of allowance. So thus, the accounts receivable balance is the net realizable plus the allowance will give you this. Okay, so it's all connected. It's all connected. But again, it's important never, never, never to overstate your assets on the balance sheet. We have to use conservative estimates and conservative principles to make sure our assets are not overstated. Okay, so I'm not going to do this because it's just not necessary. But I will show you the difference in how a direct write-off method works compared to the allowance account. So for folks that use, and smaller companies can use the direct write-off method without a problem. Here, if you notice, this company is Warden Company. And they want to write off the account of M.E. Doran. Emmy Doran has owed them $200 for some time. They have decided it's uncollectible on December the 12th. So what do? Well, they can simply expense it. So what they can do with the direct write-off method is simply debit the bad debt expense for the amount that's owed, credit the accounts receivable for the client to zero out the client's balance. Now they're not expecting anything from that client because the client's no longer part of the receivable record. Okay, they've written that client off. Corporations can't do it. They have to use, as you see, this is not desirable. What they have to use is something called the allowance method. The allowance method is only done at the end of every fiscal year. Okay, so at the end of their accounting year, they, first of all, they estimate how much of their receivables are going to be uncollected. Now, you might say, well, how do you do that? You're going to find out in a moment. But in general, they had historical records. Most businesses have been around for some time. So even if you look back and say, we usually, out of every $100 we're owed, we don't collect 2 of those. So 2% is an idea of how we estimate. So that's one way to estimate. And you'll see that's probably the easiest thing to do, but it may not necessarily be all that accurate. Does it have to be accurate? No, it's an estimate. Okay. The estimate has to be good, but it doesn't have to be, accurate, like, striking a nail on the head, accurate. So at the end of the year, and only at the end of the year, after they estimate what their uncollectible accounts is supposed to be, they will debit their bad debt expense and they'll credit the allowance for doubtful accounts for that amount. Okay. Again, the allowance for doubtful accounts literally goes right underneath the accounts receivable account. So it technically is an asset account, but it has a credit balance. So it's a contra asset account. Okay. Well, and that only happens once a year. That's the important thing here. It's only happening at the end of every fiscal year. So what happens as the year goes on and they identify, schmucks are not going to pay? Well, that's the third step. They simply will take the money out of the allowance and close out the receivable of the person or company has not paid. Okay. And that's where they find that money to write off so it's not a direct write-off method where they can just on any particular day have a bad debt expense. The bad debt expense under the allowance method only happens at the end of the year. All that money is credited in the allowance account, and that is the money that's used through the year to close any receivables. Okay. So how does this look? Here's an illustration. Hampton Furniture has credit sales of $1.2 million. And this is an interesting term. I don't know if we actually have seen it before. But a credit sale is a sale on account. Okay, so I'm still that restaurant supply company. You own a restaurant, you come in and buy some stuff from me. I sell it to you and give you an invoice, give you a bill. I've sold you that merchandise on account. That's a credit sale. Same thing. So they had credit sales of 1.2 million in the year 2017. So this is for the entire year. So again, just 12 months to a year. So having a lot of credit sales is always a good thing, but you're also collecting some of this every other month, right? You're collecting part of it. But 200,000 of the 1.2 million is still uncollected by the end of the year. Okay. So $200,000 is their accounts receivable. The credit manager estimates that $12,000 of that, of the 200,000, will be uncollected. It's the end of the year. We got to have our bad debt. So let's do it. Bad debt expense will be debited for $12,000 because that's the estimate. And that's the amount that's put into the allowance for doubtful accounts. Again, on the credit side, because it's a contra asset. Well, how does it look? Again, this company has $200,000 of receivables, and they just put $12,000 aside of it for bad debt. Well, this is how it's going to look on their balance sheet. Here's the accounts receivable. The $200,000 still is there. However, now they're telling their stockholders that they have allowed for $12,000 of that to be bad debt. And so this $188,000 is the net realizable value of receivables. And that's how they do it. That's how they make sure that the accounts receivable number on their balance sheet is not overstated. Okay, that's something. So this allowance method works for them. Okay, so they did that in December. Now it's March, and they've identified one of the folks that haven't been able to pay. So it's March the 1st already, and they've identified $500 from this client, R.A. Ware. Okay, and maybe they are aware they're not going to get the money. Dun-dun. Or they're sick of saying, where is this guy's money? Either way, they have identified his account or her account, I'll just say his, on March the 1st. So now they can actually write his account off according to the allowance method, which means they're going to take the money from the allowance account and use that money to close Ware's receivable on the books. So now they're not waiting for $500 from Ware in their receivables. They're looking for all the other folks that owe them money, but not R.A. Ware, because they've identified him as a schmuck who's not going to pay. I'm sorry if I'm using tough language. And I know his cousin. I am aware. So this is the journal entry. This is how it posts into the ledger. Okay. Notice that the allowance account gets reduced here, $500. And the accounts receivable get reduced $500. Guess what? The net realizable value of receivables is still $188,000, because the difference, here's your accounts receivable balance, new. Is your allowance for doubtful accounts balance, new. It's still going to be 188. No change to the balance sheet. Well, lo and behold, A, this is a textbook. B, he comes back to pay his bill. On July the 1st, R.A. Ware comes back in and says, look, I got that $500. I was just down in Jersey playing a little sports betting, and boom, hey, I made the right call. You know, it was a hole in one. So I got some money, I want to pay you. They say, good, yeah, we'll take your cash. As a matter of fact, if anyone does come in late with cash, you always take it as a business. I mean, why not? So what do they have to do? He doesn't know, R.A. Ware does not know that he has been written off, okay, in March. And you don't have to tell that person he's been written off, okay. So what do? Well, the first thing you need to do is put his account back on the books, because you wrote it off. So now reestablish his account in accounts receivable and stick that money back in the allowance account for the next schmuck you identify, okay. And then take the cash. Take the cash. Because ultimately, this is what's supposed to happen with all your receivables, right? After 30 days, they're supposed to send you the cash. They're supposed to. This is the way it's supposed to work with receivables. You extend a receivable, and then they pay you the cash 30 days later. So you're going to debit the cash and credit receivable. That's what you want to do. That's normal. That's what you're expecting. Okay. So does this ever happen? Do folks like R.A. Ware actually show up and say, hey, I got that $500 that I owe you? Yes, it does. It's not, I mean, it is a textbook thing, but it does happen because, like I said, if I'm that restaurant supplier And R.A. Ware maybe was one of the restaurants that did business with me, that got supplies from me. Maybe his restaurant went out of business for a while or closed for a while, and he didn't have the money. But now that the business is open again and he came into some money, he wants to reestablish that relationship. So he's going to pay me what he owes me, and he's going to want to reestablish that relationship. But I'm not going to sell him stuff on account right away because, hey, the guy stiffed me for several months. I will sell him stuff for cash for the first few times. And then if he's doing okay, I might go back to extending credit for him. So yes, it does save relationships, business relationships, when you decide to do that. So this does happen. Okay. Every company, every public company needs to explain in their financial reports how they're doing their allowance for uncollectibles. Okay. Two of the popular ways. The very first method is the easiest method. It's simply a percentage of receivables. 2% of our receivables has been traditionally bad debt. That's what you're going to use for estimate. 2% of whatever the receivable is. Boom. That's your amount of bad debt. Piece of cake. The other is a little bit more, this is the second method. It's a little bit more detailed, as you see here, and it's called an aging. And of course, I am aging in front of you all semester, but this is a little bit different because I am not a receivable. So what an aging is basically is you make a list of all the customers who owe you money. And here's the list here, right? And then all the others are stuck here. And then you put the total amount of money they owe you. So this particular company has $39,600 of accounts receivable, right? So this is the total of all their customers. And of course, they have more than these 5 customers because all the others are not listed. Okay. And then you got to understand what a receivable is, right? You're selling to someone on account, you're giving them 30 days to pay you. And so most of these receivables probably aren't due yet. And as you see here, of the $39,600 that is the total receivables, 27,000 of that 39 is not even due yet. So you're really kind of not worried that most people are not going to pay. You think that actually most people are going to pay. But you need to estimate. And so here, look, they've estimated that 2% of the folks who they've just extended credit to are likely to not pay. That's the allowance they're doing. So this $540 is 2% of the 27,000, and that's what they've decided. The next columns are all are broken into the number of days in which they are past the due date. So the first column here shows that these folks are anywhere from 1 day behind. We were expecting it yesterday, and today we never got anything. So they're 1 day behind, up to 30 days behind. So nothing to really worry about too much. Some people do lose track of time. Some people forget. No big deal. But still, it's important to keep track of. $5,700 of the $39,700 are late by 1 to 30 days. Well, just because they're late for 1 to 30 days doesn't mean you have to, worry too much about it. But you are expecting a bit more of them not to pay you. So you have estimated that now 4% of this money will probably be uncollectible. Boom. These are the folks that are 1 to 2 months late. Hello. But thankfully, the amount is small. 3,000 of the 39,000 is 1 to 2 months late. Now look at that. They've went from 2% normal to 10%. They're thinking now these folks are 5 times more likely not to pay. If we're still waiting 1 to 2 months later, we're probably not going to see more of that money. So they have estimated that 10% of that, or $300, is not going to be collected. 2 to 3 months late. Hello, that's a long bath. $2,000 of the $39,000 is 2 to 3 months late. Well, the longer you wait for your money, the less likely you're going to get it. Okay, just for you to know. So now look, they've done. They've gone from a base of 2%. Now they think this is a 10 times worse situation. They think 20% of that money is not going to be collected. So 400 of the 2,000 they think they're never going to see, and it's going to be part of their allowance. And over 3 months, forget it, a lot more. So here they got 20 times their normal. 760 of that they don't think they're ever going to see. When you add all these up, this is what their allowance account should be. $2,228. Okay. And if this is their very, very first year doing this, that would be exactly what they would write off as their bad debt. But like I said, companies have been keeping records year to year to year. So they kind of have an idea of what they're looking at. And sometimes when they're actually doing their bad debt at the end of the year, they might already have a balance in their allowance account to look at. So in this case, the company wants to have their allowance at 2228. That's what you just saw on the aging. But the problem is they already have $528 there on the credit side. So they want their credit balance to actually be 2228. So what can they do? They can only write off the difference. So their bad debt expense is only going to be the $1,700 difference, because they only need $1,700 more in the account to get the allowance to 2228. You can't ignore a previous balance in the allowance account when you're calculating what your bad debt is. You can only, your calculation is what your balance should be. You compare that to what's already there. Okay. So it's kind of like going for another, glass of juice. You got an 8-ounce cup of juice, but you still got 2 ounces of juice in the cup. You understand if you pour 8 ounces, you're going to overflow, right? You can't do that. So you can only pour 6 ounces because there's only 6 ounces of room left in the glass because it's an 8-ounce glass and there's already 2 in there. Same thing here. You can only adjust your allowance account to the amount that you want it. Whatever's the difference, that's what your bad debt's going to be. Okay, so that's the trick here. That's really the trick here. If there's a balance there and you've estimated what's the difference, that's what you're writing off. Okay. So here's a do-it exercise for bad debt. Brule has been in business for 5 years. So they have records. And this is what they have. They have accounts receivable of $30,000 debit balance. Sales revenue of $180,000. That's nice. And they have an allowance for doubtful accounts. But this is interesting. It's a $2,000, but it's a debit balance. Our allowance account usually has a credit balance, right? So if you look at the allowance account, what you see here is there's a $2,000 debit balance in there. That's what this says in the allowance account. Well, that's a problem because the allowance account is a contra asset. It's going to have a credit balance. So what should the balance be? Bad debts is supposed to be 10% of receivables. 10% of receivables means that the balance should be $3,000 on the credit side. Well, how do you get from a $2,000 debit side balance to a $3,000 credit balance? Well, you're going to need a big ass $5,000 credit here to get there, which means that your bad debt expense for that year is going to be $5,000. It's going to be much larger. Okay. Question. Okay, yeah, sorry. No question. All right, so that's what's going on here. Okay. Couple of interesting little things too to know is that receivables are assets that actually can be sold. When companies need cash, a lot of it, of course, they will have a line of credit at the bank. They'll go get some cash from the bank. But if they still need more cash, they can actually sell their receivables to a company called a factor. A factor is a company that specializes, it's a financial company or a bank that specializes in collecting receivables. They buy these receivables from businesses at a discount. So the discount is their fee. Their discount becomes their profit. Okay. So this is how that works. So assume here that this furniture company factors off, which means they sell 600,000 of receivables to this company, Federal Factors. Federal Factors charges 2% of that amount as a fee. Okay, or in other words, they're going to charge $12,000 to buy those 600,000. So how does the furniture company handle that? Well, they're going to get rid of $600,000 of receivables, yes. But as you see, they're only getting $588 of cash. The $12,000 is going to be expensed as a fee. Okay, so this will raise enough cash to meet whatever need they have. But it's obviously less than the value than their receivables were worth. Credit card sales are actually cash sales to a business because they're not giving you the credit. They're not giving you a loan to buy the stuff from them. The bank, whoever issued your credit card, which is a bank, the bank is giving you a loan to buy stuff. So when you go to a merchandising place and you use your credit card, it's a cash sale for them. Okay. Now they're not getting all of the cash because in order for the retailer to accept that card, they have to be part of the network. So whether that network is Visa, MasterCard, Discover, American Express, there's a bunch of them out there, as you know, and every network has a fee to be part of it. So that means for every sale that a retailer makes, they're giving up a portion of that as a fee to the network. Now that's important to retailers because they tend to make a lot more sales when they accept credit cards, okay? Or they're part of that network, Visa, MasterCard. They tend to make more sales. And so it's in their best interest to do it. They'll expense the fee, just like they expense everything else. You know, that's a cost of doing business. They don't have to do any credit investigation on you before they decide to sell you on credit because they're not selling you on credit. They're getting the cash. Okay. Matter of fact, they get the cash within anywhere between 1 and 3 days after you swipe and it gets approved. The bank will forward through the network to their account, usually within a day or two, minus the fee. Okay. It really, I mean, it's the bank who issues the credit card, so they do the investigation. It's the bank who maintains the customer record. The merchandiser doesn't. It's the bank that basically takes the risk of collection. If you don't pay, you're not paying the bank. The retailer already has the money from when you bought it from them. So it's a big plus to retailers to take this. And a quick illustration of how it works is, let's say Morgan Marie has a restaurant and she buys $1,000 worth of CDs from this music company. She uses her Visa. However, the music company charges a 3% service fee to be part of that. So what's the music company going to be putting down on their books? They just sold $1,000 worth of goods to Morgan. Well, they're going to record the sale as $1,000 sale because it was indeed a $1,000 sale. But as you see, they're only going to be collecting $970 in cash. And the other $30, which is the 3% of the 1,000, is going to go down as a service fee, okay, or service charge expense. It's an expense account to the company. And that's basically how they work. Okay. So again, really quick, do an exercise here regarding factoring. Here you have a company, Peter Kell Wholesalers. They need to raise money for payroll. Okay, that's a good reason to raise money. They have a lot of receivables on their books. They're going to sell off 125,000 of those to alleviate their cash crunch. And there's a 1% service charge. So what do they show? They show they sold off 125,000 of receivables. Receivables are reduced. They collected $123,750 in cash, which is plenty to meet their payroll. And the difference, that 1% difference, is going to be a service charge expense. All right. A quick tour of notes receivable. Okay. A note is a loan. It's a loan. It's a promissory note. Right? It's a loan. And so this is common. What does it look? And actually most of it here, most of these loans are basically to settle accounts receivables. Although it's quite possible companies lend each other money through that. But overwhelmingly, most notes receivable are born from accounts receivable needing a lot longer to pay. So they just turn it into a loan. How the notes receivable look is basically there's a payee, which is the folks who are going to get paid this. And then there's the maker, who are the folks who are going to pay. Okay. So Brent Company is going to be paying Wilma a note. $1,000 is the loan for 2 months from the date. So if it's in months, it's simply just adding. So May 1st, June 1st, July 1st. So this will be due July 1st. There's going to be, because it's a loan, there's going to be an interest rate. The interest rate is annual. It's really for 12 months, although the interest is only going to accrue for 2. And then that's a note. That's a note. So let's see how that plays out. Okay. So notes, by the way, are either going to be expressed in terms of months, which you just saw. Some notes are expressed in days. And if they are expressed in days, they go in 30-day increments, 30, 60, 90, 120, etc. So they assume a 30-day month, and that means they are assuming a 360-day year if the note is in days. Okay, if the note's in days. The thing you have to know about this is how to compute interest. That's really the main part of this. Part of the chapter is notes carry interest. If you're interested in this. So how we're basically doing it is to calculate interest, you take the face value of the note, which is the actual loan itself. You multiply by the interest rate, knowing that the interest rate is for the whole year. And then you multiply it by the time of that note. And the time is going to be either expressed in days or months. If it's expressed in days, like this first note, $730 note at 12% annual for 120 days. Well, at 120, that time period here is going to be 120 days divided by 360 because it's a 30-day month. That's the assumption. 360 is 12 months. So 730 times 12% times 120 divided by 360, you got your interest of $29.20. Now, why this is important is because the interest and the loan are going to be paid on the same date. The maturity date or the due date is when everything gets paid back on a note. Okay, the loan gets paid in full with interest on the same day. If it's in months, it's the same, right? The amount of the loan times the interest rate, which is an annual rate, which means it's all 12 months. So because it's less than that, you multiply it by, in this case, 6 months over 12 months, and you'll get $45. So this $1,000 and the 45 will all be paid on the same day, 6 months from whenever it was made. And that's the real critical thing here for notes. How they recognize notes on the book on the day that it's written. Oops, sorry, went too fast, my bad. On the day that it's written, in this case, most notes are to settle an open account, which means that they're using a notes receivable to pay off their accounts receivable. And this is what it would look like. And then, as you know, notes can either be paid on time, in which case we say they're honored, or notes can be not paid on time, which is a dishonored note. When I mean on time, it means it's paid in full on the maturity date, which is the date it's due. When I say dishonored, I mean, it's not paid in full at maturity on the day that it's due. So here is another illustration of a company that honored the note. Wolder lends Higley $10,000 on June the 1st. It's a 5-month note. So June 1st, 5 months, July, August, September, October, November, 5 months. It's a 9% interest. That's an annual interest. So what happens on November the 1st when that gets paid? Well, they're going to be collecting both the $10,000 note plus the interest on the note all on the same day. And so the cash amount is going to include the $375 of interest that the note has earned. So cash is $10,375. You have to know how to calculate that. That means that the note receivable was paid back. That $10,000 note was paid back. The additional $375 was interest earned on the note. So interest earned is revenue. And so any interest that's earned on loans that companies make is revenue for that company. Of course, it's very easy. This is one of the main accounts for banks. Interest revenue account is their main revenue account. But for companies that just do these notes receivable on a small scale, and they collect interest on those, that's revenue as well. All right. This says what if the same note that's due November the 1st, but their company closes their books on September 30th. Well, on September 30th, you would make the adjusting entry that you made back in chapter 4. Recognize the interest revenue for $300 for that year and set up a receivable. Okay, because 4 months of that loan were in one fiscal year. 1 month of the 5 months loan is in another fiscal year. So they're just splitting it up, but no big deal. Okay, here. And that's your notes receivable in a nutshell. Okay, so in this case here, your do it exercise has a 90-day note for $3,400 at 6%. And it's in settlement of an overdue account. So that's a note receivable to pay an accounts receivable. The maturity date of this note is the 8th of August. And so on the maturity date, Leonard pays the note in full. What does Gambit put down on their books? They're going to put down that they received $3,451 in cash. $3,400 is the original loan, so the note has been paid. The $51 is interest, which is now part of their revenue. And that's the deal. The last thing, learning objective 4 is actually the shortest part, but it's very important. So the first thing they show you is how receivables can be presented on the balance sheet. As you see here, this is for Deere and Company. Does anyone, you've heard about Deere and Company? Does anyone know that company? They make tractors and farm equipment and things like that, yes? You've heard of it? I hope so. So as you see here, Deere has listed quite a lot of receivables. I would say that that's a lot of dough for Deere. Yes, yes. You'll also see they subtracted out their allowance. But even after subtracting out their allowance, their net value is still quite a few bucks. All right. So let's go to the financial analysis piece here. The turnover rate for accounts receivable is the number of times that a company is supposed to collect its receivables every year. So if you assume you're collecting things every 30 days, your accounts receivable turnover is going to be 12 times a year, because there's literally 12 months with at least 30 days in each of them on average. Yeah, I'm sorry, February. So that means 12 times a year would be a receivable turnover that people would look at. because most receivables are due in 30 days, so 12 times a year. Once we know how many times a year your receivables are turning over, you can actually find out the exact number of days, which is what the average collection period tells us. So let's go to the illustration here. Here is the accounts receivable turnover ratio. It's simply the credit sales divided by the average receivables, beginning and ending accounts receivable divided by 2 gives you the average. As you see, the information from Nike is presented in 2014. They had 27, I'm sure this is billion, $27,799,000,000 of credit sales. And they averaged out their receivables, beginning and ending receivables divided by 2. And they came out with 8.5 times. That means that Nike collected their accounts receivable 8.5 times a year. Well, that's not 12. That's not 12, right? So they're behind a normal schedule because 12 times a year is really what we're looking at, right? Compared to Skechers, Skechers had an accounts receivable turnover of 9.6 times. So that's better than what Nike did. I guess you can say they're running ahead of Nike in accounts receivable. But wait, there's more. The industry on average is doing well. 12.2 times is exactly what you would expect, 12 times a year. That's when you should be collecting your receivables, yes? Right. So Skechers is a little bit behind that, so that's looking a bit sketchy. And Nike is really, I mean, what are they doing? Jogging here? Oh, I mean, they're in a they're not in a marathon, they're in a sprint. This is got to be done quickly. So in terms of the turnover rate, certainly both Nike and Skechers are behind what everyone else is doing in that industry. Now that you know the turnover rate, you can actually find out exactly how many days they're collecting it. That's the average collection period. You take the turnover rate and stick it underneath 365. And as you see, Nike is collecting their receivables every 42.9 days. Can we just, daylight savings, we can just, round it to 43 days, okay? It's dark early. So 43 days is fine, but they're supposed to be collecting them every 30 days. They're waiting 13 days longer to collect their receivables. Not good. Skechers, when you put 365 above 9.6, you're going to get 38 days. So Skechers is, waiting still longer than 30 days to collect their receivables, 38 days. The industry seems to be on target here. They are collecting their money every 29.9. Again, let's throw it in 30 days. That's exactly the way it's supposed to be. So I don't know. I mean, I think this is enlightening in terms of the fact that the industry can collect in 30 days, but Nike can't, right? So if I were the VP of finance at Nike, I would get everybody in the room there and say, look, this is where the industry is. This is where we are. Just do it. Thank you very much. Thank you. Thank you very much. I'm here all week. That, my friends, is a lot of puns for one chapter. Questions? How you doing?